Hey everyone, I'm Professor Franklin. What if I told you that millions of people across America are suddenly receiving more money this year without asking for it? Not a bonus, not a raise, not a lottery win, but a check from the government, bigger than expected. And the numbers behind it? They're massive. $202 billion returned. But here's the real question. Why are tax refunds suddenly rising? And more importantly, what does it actually mean for your money, your future, and the economy as a whole? In 2026, something unusual is happening. According to new data released by the Internal Revenue Service, the average tax refund has jumped by nearly 11% compared to last year. That means the typical refund has increased from about $3,200 to over $3,500. Now, on the surface, that might not sound life-changing, but zoom out, and the scale becomes clear. More than $202 billion has already been sent back to taxpayers this season. That's not a small bump. That's a massive flow of money back into the hands of everyday people. And yet, this story isn't just about bigger refunds. It's about why they're happening. Let's break this down. As of March 20th, nearly 57 million refunds had already been issued. At the same time, around 79 million tax returns were submitted. Interestingly, that number is actually slightly lower than last year. So think about this for a moment. Fewer returns, but more money being refunded. That tells us something important. This isn't just about more people filing taxes. This is about larger payouts per person. And when that happens, it usually means one thing. The system itself has changed. Behind the scenes, a major tax law is playing a critical role. A policy introduced recently has reshaped how taxes work in the United States, and its impact is now showing up in people's bank accounts. This law made several key changes. It kept income tax rates lower for both individuals and businesses. It extended standard deductions. It expanded tax exemptions across multiple categories. In simple terms, it allowed more people to keep more of what they earn. And when tax time arrives, that often translates into larger refunds. But that's not all, because this law didn't just adjust rates. It introduced the targeted benefits. Let's look at some of the key changes. For example, certain tipped workers can now avoid taxes on a portion of their income, up to a defined limit. For older Americans, there's a new deduction designed to reduce tax burden later in life. Homeowners and taxpayers in high-cost areas now have increased limits on deductions related to local taxes. And even car buyers. They may benefit from deductions on interest payments under specific conditions. Each of these changes may seem small on its own, but combined, they reshape how much money people owe and how much they get back. There's another shift happening, less visible, but just as important. The way refunds are delivered is changing. The IRS is moving away from paper checks. Instead, the system is becoming almost entirely digital. In fact, around 90% of refunds are already being sent electronically. Direct deposits, faster processing, less waiting. This isn't just about convenience, it's about speed, and speed changes behavior. When money arrives quickly, people spend it differently. They plan differently, and sometimes they don't even realize how fast it came. Now here's where things get interesting. A bigger refund sounds like good news. More money in your pocket, more flexibility. more breathing room. But let's pause for a second. Because a tax refund isn't exactly free money. It's money that was already yours, given back after being held throughout the year. So the real question becomes, is a bigger refund always a good thing? Or does it reveal something deeper about how money flows? For many people, a tax refund feels like a bonus. It's treated differently than regular income. People are more likely to spend it quickly, use it on larger purchases, or delay decisions they would normally think through. This is known as mental accounting, where money is categorized based on how it's received, not its actual value. So even though a refund is technically your own earnings, it often feels like something extra, and that feeling drives behavior. Now scale that behavior across millions of people, over $200 billion entering the economy. That kind of money doesn't sit still, it moves. Into stores, into services, into debt payments, into savings. Sometimes, tax season becomes a kind of economic pulse, a moment where spending surges. And businesses know it. Retail promotions rise. Marketing increases. Spending spikes. Because when people receive money in large chunks, they act differently than when they earn it gradually. But here's the deeper truth. Not everyone uses their refund the same way. Some use it to pay off debt, build savings, invest for the future. Others use it to temporarily upgrade their lifestyle. And over time, that difference compounds. Two people receive the same refund. One builds stability. The other resets to zero within months. The refund wasn't the deciding factor. The decision was. The 2026 tax season began in late January, and it's set to end on April 15th. That means millions of people are still in the process of filing, still waiting, still expecting their share. And as the deadline approaches, the final numbers will grow even larger. More refunds, more money, more impact. So what does all of this really mean? Yes, refunds are higher. Yes, policies have changed. Yes, more money is being returned. But underneath all of that is a bigger story. This is about how financial systems influence behavior, how policies shape outcomes, and how individuals respond to both. Because money doesn't just move through systems, it moves through decisions. A larger refund might feel like progress, and in many ways, it is. But the real advantage isn't in receiving money. It's in what you do next. Because every dollar returned is an opportunity to reduce stress, to build stability, to create options for the future. And those opportunities, they don't come from the system. They come from your decisions. This year, billions of dollars are being returned to millions of people. But only a fraction of that will turn into lasting financial change. The rest will disappear quietly. So the question isn't, how much did you get back? The question is, what will you turn it into? This is Professor Franklin, and understanding money is the first step to controlling it. I'll see you in the next lesson.